And welcome to today's meeting of the SEC's Small Business Capital Formation Advisory Committee. I call this meeting to order. I want to extend a warm welcome to everyone. It's so good to see all of you. We also appreciate members of the public who have tuned in to watch the meeting via webcast on sec.gov. Courtney, do we have a quorum for the meeting today?
Hi, Erica. Good morning, everyone. Yes, we do have a quorum, and I would also like to take this opportunity to give the SEC disclaimer for the meeting. For any SEC staff that speak today, any views provided are in the speaker's official capacity as staff, but do not necessarily reflect the views of the commission, the commissioners, or any other members of the staff. Thank you so much, and have a great meeting, everyone.
Thank you, Courtney. Our meetings frequently focus on ways to expand access to early stage capital raising for good reason. We are the SEC Small Business Capital Formation Advisory Committee. Not too long ago, we proposed modifications to regulation crowdfunding, and before that, we recommended changes to the definition of accredited investor. All of these recommendations were made with a view towards positively affecting capital raising for both entrepreneurs and investors. Today, we'll focus on the practical market considerations and regulatory challenges of Regulation A. This is an area that I suspect many of us are still unfamiliar with. We're really looking forward to learning more about Reg A and to the committee's discussion on this topic. One of our goals today will be to try to understand more about why some issuers pursue Reg A and why more issuers do not. I know that I have a number of questions that I'm looking forward to exploring during this meeting. For example, what are the advantages and limits presented by this capital raising pathway? And is there anything that can be done to reinvigorate it? Are there regulatory changes that could be undertaken to help facilitate more capital formation pursuant to Reg A, or are the friction points elsewhere? And would a more robust secondary trading market perhaps attract more Reg A investors? But before we get into that, we are so pleased to have Chairman Atkins and several commissioners join us today. I want to extend a special welcome to Chairman Atkins, who is joining us for the first time, though he is no stranger to the SEC. On behalf of the entire committee, we look forward to working with you in the coming years. To all of the commissioners, we really appreciate you being with us this morning. Chairman Atkins, would you please start with your remarks?
Oh, great. Well, and really pleased to see all of you today. And like Courtney said, of course, the obligatory disclaimer, my views are my own and not necessarily those of the commission. So today is the 6th anniversary of the first meeting of this committee, the Small Business Capital Formation Advisory Committee. And since that initial meeting, I've followed the discussions and recommendations by the committee from outside the agency, of course. But now it gives me really great pleasure to have the opportunity to address the committee for the first time as chairman. It's particularly appropriate that this meeting takes place during this year's National Small Business Week, when we are recognizing America's entrepreneurs and small business owners. So this committee serves the important function of advising the commission on achieving its three-part mission, which of course is protecting investors, facilitating capital formation, and maintaining fair, orderly, and efficient markets. And in particular, as that three-part mission relates to emerging privately held small businesses and smaller publicly traded companies. The committee's voice will be critical over the years, and as I intend for the commission to focus on providing meaningful pathways for entrepreneurs to obtain the capital that they need to execute their innovative ideas and grow their companies in both the private and the public markets. At the same time, those that provide capital have to be able to continue to depend on effective enforcement against fraud and other bad activities. Today, this committee will explore how companies have used Reg A for capital raising and discuss improvements that can be made to facilitate greater use of the rules. Companies have raised approximately 3 times as much capital under Reg A as compared to, for example, Reg crowdfunding and Rule 504 combined. However, the amount raised under Reg A is less than 1% of the capital raised under Reg D rules 506B and 506.3 combined. Although the commission raised the offering limit under Reg A from 50 million to 75 million in March of 21, there has not been a significant number of Reg A offerings seeking to take advantage of that increased limit. In fact, the overall number of Reg A offerings has declined over the past 2 years after increases during the prior 3 years. Besides increasing the offering limit, what else can be done to incentivize greater use of Reg A? In September of 22, this committee recommended that the commission, quote, provide federal preemption from state regulation for secondary resales by investors of securities initially sold pursuant to Tier 2 agreement. Although the commission has not acted on this recommendation, the committee should consider further evaluating whether federal preemption can help alleviate secondary market liquidity challenges associated with securities sold pursuant to Reg A. Additionally, at-the-market offerings are currently not permitted under Reg A. So would eliminating this prohibition provide entrepreneurs with a more effective way of obtaining capital without sacrificing investor protection? Finally, use of Reg A has been concentrated in just 6 states, so California, Florida, Nevada, New York, Texas, and Washington State. Most other states do not have more than 2 Reg A offerings at all. So why is there a geographic concentration for use of Reg A, and would decreasing the concentration make the rules more viable? So beyond these specific issues, Reg A certainly has not been a viable regulatory framework for widespread use by certain issuers, notably those offering crypto asset securities, to raise capital without disproportionate compliance costs. As this committee considers amendments to Reg A, I encourage it to evaluate broader changes as well as targeted revisions with the goal of making the framework an effective regulatory regime for all types of issuers. So I look forward to the presentation this morning by Daniel Foreman of Lowenstein Sandler, as well as the committee's discussion of these and other Reg A issues. I'm also excited about the opportunity to hear from this committee each quarter on important issues affecting emerging privately held small businesses and smaller publicly traded companies. So thank you very much, and turn it back over to you.
Thank you so much, Chairman. We really appreciate your remarks. Next, I'd like to invite Commissioner Ueda for remarks, please.
Well, thank you, Erica. But I see Commissioner Crenshaw is on. I think in seniority, she would take precedent over me.
Okay, thank you for that. Commissioner Crenshaw?
Thanks. Commissioner Ueda and I, we spent a long time, I think until perhaps 4 in the morning in 2015, working through Reg A Plus. And I know he and I probably both feel the same way, that we are fully looking forward to feedback on what may have been good about our late night deliberations or what may have been terrible about our late night deliberations when we were working for prior commissioners. So thanks, Erica. Thanks, Commissioner Ueda. And good morning. It's a pleasure to be here with all of you. Thank you to the entire committee, as well as you, Erica, for hosting today's meeting. And as always, for the thoughtful work that you all do in helping advise the Commission on areas of importance to small business. I would also like to offer my gratitude to Stacy and the members of the Office of the Advocate for Small Business Capital Formation for your work on today's work, as well as our IT office, but also for your incredibly successful annual Small Business Forum. That's one of my favorite events every year, and it brings together small businesses of all stripes to exchange ideas, engage with regulators, and discuss strategies for success. And I think this year's conference was outstanding by every measure, and I'm grateful for the hard work and thoughtful consideration that went into that. So today we're focusing on Reg A, as you've heard, and the Commission has long recognized that the economic fortunes of our national economy are tied inextricably to the fortunes of our small business community. As the small business advocate recently pointed out to Congress, roughly 80% of the net new jobs created in this country since 2011 were created by small businesses. Reg A, the subject of today's discussion, was first promulgated by the Commission in 1936 and was an early acknowledgement that one size may not fit all when it comes to the registration of securities offerings, particularly those of our small business community. The Commission reemphasized this principle in 2015 when it implemented Reg A Plus pursuant to a congressional directive in the Jobs Act. And Reg A Plus, as you'll hear today and as you'll hear more, comes with 2 tiers of offerings. Tier 1 offerings, which allow issuers to raise up to $20 million in 12 months, and Tier 2 offerings, which currently allows for raises up to $75 million over that same 1-year period. Issuers in Tier 2 offerings are required to provide investors with audited financial statements and periodic reporting. Tier 2 offerings also receive preemption of certain state securities law requirements. And Reg A Plus was approved by the Commission in a 5-0 vote. So it's come a long way. From 2012 to 2014, immediately prior to the Commission's amendments, there were 26 Reg A offerings. From 2021 to 2023, those numbers were up to about 970 offerings. But as you've heard, it remains significantly less utilized than Regulation D. So that's what brings us here today. And I think with that, there are many questions, Erica's already raised a number of them, that I think deserve attention. Why is Reg A less utilized than Reg D and certain other exempt offerings? And what do the data show? And should we amend Reg A to make it a more appealing option for small businesses? Or should we concentrate our efforts on other potential avenues of capital formation? In other words, is Reg A the right one to spend our time and attention on? We are an agency of limited resources. So how should we think about prioritizing those resources when it comes to serving our small businesses? Should we revisit the Tier 1 and Tier 2 thresholds? And if we do revisit those thresholds, which we last did in 2020, what data should drive our reconsideration? Are there different concerns present for each of the tiers? How much do we expect the fundraising to increase at different potential caps? Alongside these considerations, what parallel changes should we think about making to investor disclosures to ensure that important information about our small businesses are getting into the hands of the investors who will fuel those cash needs? Burgeoning businesses are, by their nature, riskier endeavors. How can we balance the cost imposed by disclosure with the very real need for honest transparency? Another issue I'm sure you will visit is state law preemption. As we've heard, offerings made pursuant to Tier 1 remain subject to the blue sky laws, while Tier 2 offerings are granted certain preemptive relief. NASA, state securities regulators, and other groups have worked mightily to reduce the burdens associated with state review of smaller businesses. So what has been the experience here of both issuers and the states? And what do the data show about the increased burdens to issuers and the increased protections afforded to investors under this current regime? As you answer these questions, keep in mind that the balance the regulators internalize as we contemplate change. We must do more to serve our small businesses, and we must do so with market integrity and investor protection in mind. Our success is measured by the success of the communities we serve and protect. So thank you for our speaker today, and I look forward to the discussion on the important issues of Reg A. And I want to just leave you with one final note. We are, of course, in a period of rapid change, and both data and anecdotal evidence indicate that recent market volatility has been felt most profoundly in our small businesses. Many of the policy shifts behind this volatility are outside the remit of this agency. Changes in tariffs, immigration, tax policy, inflation policy, and the availability of federal grants for small businesses. Those all fall outside of our proverbial wheelhouse. but helping our small businesses survive or even thrive in times of profound uncertainty does fall squarely within our ambit. So the work of this committee in providing advice and recommendations as to how we best serve our small communities is more important than ever. And we're going to see many changes in the coming months, and it will often occur in the name of lifting our small business communities. But here's my advice to you. Hold us all to account. Make sure that the changes being made are in fact designed with small businesses in mind. If larger, more mature issuers are able to use the exemptions designed to promote small business capital formation, that potentially leaves less capital available to the communities that we're hoping to serve. So help us think through these issues and help us keep us honest in our mission. So thank you, and really look forward to the discussion today.
Thank you so much, Commissioner Crenshaw, for those thoughtful remarks, as well as the guidance. We really appreciate it. We have some recorded remarks from Commissioner Peirce, but first I'd like to invite Commissioner Ueda for remarks.
Well, thank you, Erica, and good morning. I'm pleased to join the second meeting of 2025 for the committee. Today, I particularly appreciate the committee's focus on ways to expand access to early stage and growth capital raising, particularly the experience of companies using Regulation A. The Commission has a statutory obligation to consider capital formation in our rulemaking, and we try to have a rule book that benefits both entrepreneurs and investors, but we're not always as successful as we'd like to be. Conversations regarding the Commission's exempt offering regulations usually have two aspects. First is, how do we enable private companies to obtain more capital through cost-effective means? Second is, how do we enable more retail investors to place their capital into private companies? Regulation A, if administered in a manner that reflects the experience of entrepreneurs, investors, and practitioners, could help address these issues. In revisiting Regulation A and other rules, we should consider whether the existing framework is unnecessarily rigid. For example, in Regulation D, the Commission takes an all or nothing approach to evaluating whether certain investors can participate in private offerings. A person is either an accredited investor or not. This approach, however, may be an obstacle in achieving the optimal regulatory outcome. A graduated framework with a wide range spectrum of outcomes might be more appropriate. On one end, a scenario where retail investors can invest in private companies without any regulatory limitations, and on the other end, a scenario where retail investors are functionally prohibited from having exposure to private company investments. Similarly, an all or nothing scenario somewhat exists for companies seeking to raise capital. They can either pursue a fully registered offering under the Securities Act with extensive disclosure requirements, or pursue an exempt offering under Regulation D to accredited investors and have no legal obligation to provide any disclosure whatsoever. Now, I recognize there are lots of nuances in this space, such as whether a company might qualify as a emerging growth company or smaller reporting company or non-accelerated filer. They could also, in the context of an exempt offering, voluntarily provide a PPM, a private placement memorandum, or other disclosure. But as the data indicates, largely today, issuers effectively choose one of two paths: the all or none situation, either fully registered or fully exempt under Reg D. Now, Regulation A might be a third way between that gap, but it's not been frequently used even after Tier 2 was adopted after the enactment of the Jobs Act. And as Commissioner Crenshaw pointed out, she and I spent a lot of time in different capacities working on it. And one of the things when you do work on rules is you hope they'll be utilized. You hope both companies and investors will find value in that. And we really haven't seen, as Chairman Atkins pointed out, very much use of Regulation A since then. So I look forward to hearing the proposed approaches in expanding opportunities for investors in Regulation A deals, including the ability to expand exit opportunities from those who purchase Regulation A securities in a primary offering, and to evaluate and take other considerations as to how we can improve secondary market liquidity challenges for Reg A offerings. Enhancing opportunities in this space may necessitate a comprehensive evaluation of the entire investment lifecycle for these small companies. So I thank you to the participants. I thank you to the presenters for today. And again, I thank the public for joining us at this meeting. So thank you, Erica. Back to you.
All right. Thank you very much, Commissioner Ueda. We appreciate the remarks. Commissioner Peirce is next up, and while she's not able to be with us live today due to an unavoidable conflict, she was kind enough to record some remarks on this important topic, which I'm looking forward to hearing now.
Good morning, and thank you to the committee members for your continued service, and thank you to today's panelists. I was at the grocery store the other day thinking about, of course, small business capital raising. I shop at several different grocery stores, each of which has its pluses: low prices, broad selection, high quality local produce, unique items, proximity to other places I need to go. Each store also has its frictions: crowded parking lots and aisles, and annoying quarter deposits for grocery carts, limited opening hours. I often choose the store based as much on frictions I'll face in going in there as on which one has what I want that day. That quarter for a grocery cart might just be the deciding factor against a particular store on a particular day when I have neither a quarter nor the capacity to carry everything I need to buy. Just as I have choice in grocery stores, small businesses have multiple capital raising options, and the frictions often dictate the choices that they make. Reg A, the topic of today's meeting, is one avenue for small companies to raise capital, but the frictions are high. When an issuer decides to do a Regulation A offering, it first must choose between Tier 1 and Tier 2. Neither choice is completely satisfying. Issuers that offer and sell securities under Tier 1 of Reg A can raise up to $20 million in a 12-month period and have fewer ongoing disclosure obligations, but miss out on any form of state law preemption. Without state law preemption, issuers are required to register or qualify their offering in any state in which they seek to offer or sell securities, a process that can be costly, time-consuming, and confusing. Issuers that offer and sell securities under Tier 2 of Reg A can raise up to $75 million in a 12-month period and get state law preemption for primary sales at least, but are subject to more burdensome ongoing reporting requirements. Perhaps those frictions can help explain why from July 2023 through June 2024, companies raised only $1.5 billion using Reg A compared to $12 billion using general solicitation under Section 506C and $170 billion in private placements under Section 506B. A discussion of Reg A is therefore timely. Among the questions I have for your consideration today are the following. The Small Business Advocate's 2024 report showed that over the last several years, the amounts and number of Reg A offerings have continued to decline. To what do you attribute that decline? By contrast, the number of offerings raising more than $50 million has remained relatively stable at about 20 per year. To what do you attribute the fact that larger offerings have not declined? Would Tier 2 of Reg A be a more viable avenue for raising capital if secondary trading enjoyed state law preemption? If so, what conditions should apply? Should the Tier 1 and Tier 2 offering limits be raised to make Reg A a more attractive offering for a broader range of companies? And if so, what would reasonable caps be? How could the Commission streamline the regulatory obligations under Reg A without compromising investor protection? Should, as one commenter recently suggested, pooled investment vehicles be permitted under Reg A? One reason a discussion of Reg A is particularly timely is that some crypto market observers see it as a viable avenue for public offerings of crypto assets. Former committee member Sarah Hanks, for example, pointed to Reg A, in her words, as the most appropriate option for public offerings of either tokenized traditional securities or novel crypto assets without violence to the original objectives of Regulation A or the need for significant rulemaking. Do you agree? If so, should the Commission take the position that crypto tokens are equity for purposes of a Reg A offering? Would such a position conflict with how assets are treated for accounting purposes? I heard that at least one crypto asset issuer attempting to use Reg A was advised that the crypto assets should be treated as equity for securities law purposes and debt for accounting purposes. Would any other aspects of Reg A prove challenging for crypto asset issuers? Hanks suggested, again in her words, that the exit provisions to Regulation A ongoing reporting suit native digital assets that are securities at inception, but cease to be securities once a specific blockchain project has been sufficiently developed. Should the Commission, as she suggests, again in her words, confirm that when an instrument that was a security ceases to be such by reason of decentralization, completion of a blockchain project, etc., there are no longer 300 holders of record of the applicable class of securities. I welcome your insights and thoughts on the frictions associated with Reg A offerings, what we can do to address them, and any unique considerations for the application of Reg A in the crypto context. I hope you have a productive and enjoyable meeting. Thank you.
All right. Thank you so much, commissioners. I loved the grocery store cart metaphor. Very, very interesting way to frame it. So thank you, Chair. Thank you, commissioners. We very much appreciate your remarks.
Thank you. What a good meeting. Thank you.
Yes, we really appreciate your time. Next, I'd love to turn the floor over to Stacy Bowers, fellow committee member and the director of the SEC's Office of the Advocate for Small Business Capital Formation, and Brian Federoff, staff attorney in the SEC's Division of Corporate Finance, Office of Small Business Policy, who will together provide an introduction to Regulation A. We really appreciate each of them taking the time to provide us with a stronger foundational understanding of Reg A, including its history and key provisions, to help ground our discussion today. I know many of us around the virtual table have deep experience with a variety of capital raising pathways, but I think few of us are well versed in Reg A. So I look forward to hearing from Stacy and Brian and gaining a better understanding of this capital raising pathway, how it differs from a traditional IPO, and the kinds of issuers it attracts. To that end, I believe Stacy will also share with us some data from the Small Business Advocacy Office's 2024 annual report, which includes information on where and how capital is being raised in reliance on Regulation A. I think we'll all find the data and information that Stacy and Brian share will be particularly helpful in our later discussion of ways to improve Reg A. So Stacy and Brian, welcome.
Thanks, Erica. And I will say, Brian and I are going to share the stage. I'm going to lead off and provide some history. I'm going to give some overview of the exemption. And I'm going to ask Brian at any time to please jump in and tack on or say anything that he needs to say. And then he's going to talk a little bit more about their office, and I'll wrap up with reiterating some of the data that the commissioners have generally already covered. So Reg A, we often hear it referred to as a mini IPO or an initial public offering, but it actually is an exempt offering, meaning it's exempt from the registration requirements of the securities laws. So like other exempt offerings, regulation crowdfunding or regulation D, Reg A allows an issuer to offer and sell securities in compliance with the rules that govern that particular exempt offering. So just to provide a little bit of history, the 2012 Jobs Act, so Commissioner Ueda and Krenchel talked about working on Reg A, but the 2012 Jobs Act directed the Commission to adopt rules creating an exemption for offerings up to $50 million during a 12-month period. And as a part of that mandate, the Commission expanded Regulation A into 2 tiers, and I'll talk a little bit about each of those tiers. Because prior to the Jobs Act, an issuer could only raise up to $5 million under Regulation A, and so it was not used very frequently at that point in time. So what are some of the general, and feel free to pop in and ask questions as well. I'll try and keep an eye out for hands, or I'll ask Courtney to keep an eye out for hands. So what are just some of the general requirements? So first off, the issuer, the company that's doing the Regulation A offering, they have to be either organized in the US or Canada, or any state, province, or territory or possession of the US or Canada, or in the District of Columbia. Plus, the issuer has to have its principal place of business in the United States or Canada. Another general requirement is that the issuer can't be a development stage company or a company that doesn't have a business plan. So in other words, what does that actually mean? So the issuer doesn't have to actually be operating, but they have to have a business plan. They have to know what their plan of operations are going to be. And their plan of operations can't be we are doing a Reg A offering because we're going to take that money and go out and seek to acquire or merge with another company. So that's not an option for a Reg A company. They actually have to have a business plan, a business purpose. The other thing, and I believe Commissioner Peirce referenced this as well, is the issuer cannot be a registered investment company or a company that's required to be registered under the Investment Company Act. So what does that mean? That means that a mutual fund, an ETF, or probably most REITs would not be able to utilize Reg A to raise capital. The other thing I want to highlight, which I don't think comes into play that frequently, is that if the issuer who's doing a Reg A offering is already required to file 34 Act reports, meaning 10Ks, 10Qs, it has to be current in those filings with the SEC if it wants to use Reg A. But I would say that most Reg A issuers don't fall into that category of being pre-existing 34 Act reporting companies. So that's just a little bit of the general detail about Reg A. And so now I'm going to highlight just a little bit about the 2 tiers. So tier 1 allows for the sale of up to 20 or an offering of up to 20 million during a 12-month period. And as a part of that 20 million, it includes allowing for 6 million in sales by affiliates of the issuer. So the issuer can raise capital as well as allow its affiliates to sell up to 6 million worth in that tier 1 offering. The other thing that was highlighted in the commissioner's remarks is that tier 1 offerings are not preempted from the blue sky laws. So that means if a company does a tier 1 Reg A offering, it has to comply with the federal securities laws as well as the state securities laws. A tier 2 offering allows an issuer to raise up to 75 million during a 12-month period, and that includes up to 22.5 million of sales by affiliates. A tier 2 offering by the issuer is actually exempt from the blue sky requirements. So it needs to comply with the federal securities laws. I shouldn't say exempt, preempts the state blue sky laws. The other thing I want to highlight is, if you'll remember just a couple minutes ago, I said the Jobs Act said SEC create an offering up to 50 million. But as Commissioner Crenshaw referenced, in 2020, the limit was actually increased from 50 million to 75 million for tier 2 offerings. So that's just to lend some ideas there. All right, let's talk a little bit about what.
Sorry, Stacy, before we move on, could I just ask you to explain like some examples of what you mean by sales by affiliates?
And I'll have Brian jump in as well. So sales by affiliates. So affiliates is a defined term within the securities laws, and I don't have that definition memorized off the top of my head. Maybe Brian does. But think about it, it would be the idea of an officer or director would be an affiliate of the issuer, so they might be able to do sales as well. Brian, did you want to tack anything on there?
Yeah, I would just think of it as like the resale component of an offering. So you have your primary offering, and then oftentimes, when you're looking at like a IPO, you see a resale component. That's the analogy I would use.
Did that help, Erica?
Yes, thank you.
Sure. So what are some of the filing requirements? So first off, the filing, it's called a Form 1A. So if an issuer is raising capital under Reg A, they're going to look up Form 1A. They can find it on sec.gov. And what they need to do is walk through that form and comply with all the requirements that are a part. So there are detailed written instructions there. And the issuer has to file what's called an offering statement. And that offering statement goes through a review and qualification process with the SEC. So I don't want to get into the nitty gritty of everything that goes into the Form 1A, but I am going to highlight it just a little bit generally. So there are really 3 parts to Form 1A. So the first part is going to require disclosures, sort of general disclosures about the issuer itself and about the offering. And that part 1 of Form 1A, it's a little bit of a fill in a blank, check the box kind of system. So think about it, things like issuer's name, what year it was formed, where it was organized, what kind of securities are being offered, those kind of things. So it's a very, I had the form open yesterday and I'm not going to remember how many pages, but it's kind of a go through and fill in the information. It may not matter to all of you, but part of the rationale for that is that also becomes searchable information. So it's submitted in such a way that it is searchable data. Part 2 is more of what we would think of as kind of the narrative and the financial disclosures, more of like the substance. So if you think about a Form S1, which is what a company would use to do a public offering, this is going to be similar to that. And so it's going to have a very similar feel to a Form S1. You're going to have that cover page. The issuer is going to talk about its business. It's going to talk about risk factors. You know, what does its ownership structure look like? What kind of stock does it have? So it's going to go into all of those kind of details and that narrative description about the business itself. And then depending on what tier 1 or tier 2, that is going to dictate the type of financial statements that the issuer has to include. So if the issuer is doing a tier 1 Reg A offering, those financial statements do not have to be audited unless the issuer actually already has audited financial statements. So think about it. If you think back to the conversation the committee had about Reg CF, that same thing holds true. So if the issuer does have audited financial statements, even if they're doing a tier 1, they would need to supply those audited financial statements. On the other hand, if the issuer is doing a tier 2, those financial statements that it includes as part of the Form 1A, they must be audited, and they have to be audited in compliance with GAAP. So very similar to what you would see in, you know, what you might think of as that traditional initial public offering that gets filed on a Form S1. And then I will just say part 3 is just the exhibits part of the form. So I'm not going to go into a lot of detail about that, but you would look at Form 1A, the instructions, and you would see part 3. The company would have to file sort of all the material exhibits that are required there. So I want to talk a little, so that's kind of, I didn't want to get into the nitty gritty and sit here and tell you line by line everything that has to go in there, but I also want to touch on a little bit, what are the ongoing reporting requirements? So once a company does a Reg A offering, it's qualified, they engage in it, they close that offering, they do have ongoing reporting requirements. So for a tier 1 issuer, they actually have to file what's called, and I'm going to look at Brian too to jump in if I don't get it all right. A tier 1 issuer has to file an exit report on Form 1Z no later than 30 days after it either terminates the offering or completes the offering. So in a tier 1, there's that Form 1Z exit reporting requirement. On the other hand, a tier 2 issuer has more reporting obligations. So it has to file a semi-annual report on what's called Form 1-SA. And that semi-annual report does not require audited financial statements. That semi-annual report, really what the issuer is including in that are interim financial statements and management's discussion and analysis disclosure. A tier 2 issuer also has to file an annual report on Form 1Q, and that annual report does have to require audited financial statements. And I believe for 2 years worth of audited financial statements. I'm going to look at Brian to shake his head.
Yeah, for 1K.
Yeah. All right, great, thank you. And then there are current reporting requirements as well. So commencing in the year after the offering is qualified, the issuer also has to file Form 1Us. So if any kind of current event happens, so think about it, if you're familiar with the public offering process, we would think about that as an 8K filing. Here we would think about it as a Form 1U filing. So if something current that has to be told to the public happens, that happens on a Form 1U. All right, some other things just to sort of put out there so the committee has it as they're thinking about Reg A. So a Reg A issuer can do what's called test the waters. So that means it can, both before and after it files its offering statement with the SEC, it can actually communicate orally or in writing to try and determine if there's an interest in this particular offering. Now, these communications, they are offers from the perspective of the anti-fraud provisions of the SEC rules and regulations. But what it allows an issuer to do is to go out there and just kind of dip its toe in and say, hey, is it really going to be worth it for us to undertake this Reg A offering? Is there enough interest out there that we want to continue down this path? The other thing I can note about that is that about 1/3 of qualified offerings, meaning they got through the SEC review process, those issuers tested the waters. So about 33% of the time when a Reg A offering was qualified, the issuers actually did a test the waters to see if they wanted to continue forward. The other thing that issuers can do is they can submit a draft offering statement for non-public review. So basically a confidential offering statement, they can submit it with the SEC and sort of get some guidance and feedback before making that offerings, filing that publicly. Couple of other things, and this is sort of in line with other areas of the securities laws. The issuer can't make any offers unless the offering statement has been filed with the commission. And the issuer can't sell any securities until that offering statement is qualified. So again, very similar to when we think about how an S1, an IPO works. Tier 2 has an investment limitation on non-accredited investors. And that's going to be 10% of the purchaser's annual income or net worth if they're a person, or 10% of revenue or net assets if they're an entity. So again, there's going to be a limit on non-accredited investors in Tier 2. And then, as I mentioned, Tier 2 preempts blue sky laws for the issuers offering, but when somebody who purchases Reg A securities wants to resell those securities, that resale does not preempt blue sky laws. So that's one of the things that you heard the commissioners highlight, this idea of, does something need to change when you're thinking about those secondary transactions as far as preemption? So if you hark back to the conversation we had at the last meeting that Dan Zinn presented to us, he noted, I think there are 38 or 39 states that OTC has worked with to sort of have that exemption in place for companies that have done a Tier 2 Reg A offering, that they can engage in secondary resales. But there are still a handful of states that OTC is working with. So just to kind of put that out there, that is an implication of Reg A. And one of the things that we hear from stakeholders is that impacts the liquidity. So if an investor owns Reg A shares, this lack of preemption for the secondary sales can impact liquidity. So I think with that, I'm going to turn it over to Brian, and then at the end, he'll come back to me for some data, but I'm not sure it's much different than what our commissioners already shared. Brian, take it away.
Yeah, great. Thanks, Stacy, so much for sharing that very helpful background about Reg A. So now that we have a basic understanding, I'm going to talk briefly about three things. So one, how Reg A offerings differ from a traditional IPO, which is a theme that we've heard, how they compare to each other. Two, I'm going to talk about the CorpFin Reg A review process. And three, we'll talk about the types of comments that we routinely hear from the public about Reg A. But before we dive in further here, let me just start with a brief overview of my office at the SEC. So as Stacy mentioned, I'm an attorney in the Office of Small Business Policy, which is within the Division of Corporation Finance here. So broadly, CorpFin has two main branches: the Disclosure Review Program and a legal and regulatory policy arm. My office, OSBP, or the Office of Small Business Policy, sits in the legal and regulatory policy portion of CorpFin. Jeb Byrne is our office chief, and we have 4 other attorneys, including myself, and 1 paralegal. Our office houses the Commission's policy and legal expertise on private offerings. So that includes Reg D, Reg crowdfunding, and Reg A, and we also cover the smaller reporting company rules for public companies. So what I would say that our office does can be thrown into 3 main buckets of activity. First, rulemaking and interpretations related to the rules in the areas that we cover. So for example here, the Reg A and the harmonization releases that you might talk about later today, those were written by OSBP. Second, we provide internal subject matter expertise within the Commission, primarily within CorpFin. And here, I'll note that a huge component of this relates to Reg A. As you may or may not be aware, the largest arm of CorpFin is the Disclosure Review Program, which reviews the filings of public companies and companies that would like to go public. This group also reviews the filings of the Reg A filers, which can raise complex or novel questions relating to Reg A compliance. And when that occurs, our group, OSBP, is often consulted to provide our expertise on how Reg A rules should be applied. And then the third bucket is that we provide external informal guidance. So along with many of the policy offices within the SEC, we have a public-facing phone number that's there for the public to reach out to us with questions about the rule areas that we cover. And we get hundreds of calls a year from a full range of callers here, from entrepreneurs who are just starting out to attorneys and more established companies. And while we have to make it clear to callers that we cannot provide legal advice because we are not their legal counsel, we do our best to guide people to the resources that we have available, whether that be a specific portion of a regulation, a section of a commission rulemaking release, or informal guidance from the staff known as compliance and disclosure interpretations. On the point of resources here, I'd also like to just make a quick plug for the Small Business Resources page of the SEC's website, which hosts a fantastic library of streamlined OASB and OSBP resources for small businesses that you can access on the landing page. And this has been a very helpful part of our own toolbox when we are providing guidance to callers. So with all of that said, please feel free to reach out if you have any questions. Taking calls from the public is one of my favorite parts about this job. And our office truly, we love to nerd out and think about and discuss securities law questions. There's absolutely no issue that's too simple or too complex. And we have people who call in with no understanding really of the securities laws, other than knowing that there are laws that must govern, for example, someone investing in their business, and that they need to comply with these laws as they try to raise capital. And then we also get calls from sophisticated big law firms asking more nuanced interpretive questions on our regulations. So the bottom line is here that we see a huge variety of issues, and we're always happy to help. So with that overview, pretty clear, let's talk now about the differences between Reg A offerings and an IPO. And as Stacy noted here, and as you heard today, there are various disclosure requirements in a Reg A offering, some of which differ from the requirements in a traditional IPO. Aside from those disclosure differences, though, I want to highlight a few other important distinctions. So, as you probably know, and as I often say to callers that indicate that they are not familiar with the securities laws when they call in, I like to start all of these conversations with the following basic principle. Under Section 5 of the Securities Act, every offer or sale of a security needs to either be registered with the SEC or rely on an exemption from federal registration. A traditional IPO is registered pursuant to Section 5, whereas a Reg A offering is exempt from registration. And this exempt nature of Reg A results in two significant differences compared to a registered offering. And that is one, Section 5 compliance, and two, Section 11 liability. First here, because Reg A is an exemption from Section 5 registration, it is ultimately the Reg A issuer's responsibility to ensure that they are complying with the requirements of Reg A. In a Reg A offering, the Commission or the staff pursuant to authority delegated by the Commission qualifies the offering, and after qualification, the issuer must continue to ensure that they meet the requirements of the exemption throughout the course of the offering. If they do not, an issuer could violate Section 5. On the other hand, in a traditional IPO, the offer and sale of securities are registered when the Commission or the staff pursuant to authority delegated by the Commission declares the related registration statement effective instead of qualifying it. Because the issuer is complying with the requirements of Section 5 by registering the offering, the issuer will generally satisfy its Section 5 obligations for the securities offered and sold under that registration statement, although we do note that there are still non-compliance risks after effectiveness. So in addition to Section 5, there's also Section 11 liability. And Section 11 liability does not attach to offering statements on Form 1A. So what does that mean? As background here, Section 11 of the Securities Act provides a private right of action and imposes civil liability on the issuer and certain persons for material misstatements and omissions in a registration statement. Reg A offering statements are not registration statements, so unlike in a registered offering, Reg A issuers are not subject to Section 11 liability. So in summary here again, Reg A differs from a traditional IPO because 1, issuers are responsible for complying with Section 5 by means of satisfying the exemption throughout the full course of the offering, and 2, there is no Section 11 liability with respect to a Reg A issuer's offering statement. Now, let's talk about the CorpFin Reg A review process. So in connection with our selective review program in CorpFin, we see lots of different types of companies and offerings and have had the chance to consider a whole variety of issues. I'm going to highlight just a few of the areas where we've issued comments recently, which apply to companies under both Tier 1 and Tier 2. The first main issue here, or area I'll say, is offering eligibility. There are certain types of offerings that just are not permitted by Reg A. So when we consider the question of eligibility here for the issuer, we review the structure of the offering to assess whether it's permissible. So, for example, Reg A allows primary offerings to be conducted on a continuous basis, but those offerings have to commence within 2 calendar days of qualification. The rules here do not allow for an issuer to delay commencement of the offering or otherwise treat the offering statement like a shelf registration statement. In addition to these types of delayed offering concerns, we also have seen filings in which the issuer attempts to sell at a price that is not fixed or is otherwise tied to a market price, which was a point that was raised earlier in the remarks today. And these at the market offerings, they're not permitted under Reg A. The second area that we've issued comments recently is issuer eligibility. So in addition to offering eligibility, we'll consider whether the issuer itself meets the eligibility requirements. And as Stacy mentioned here, Reg A issuers, they must be US or Canadian. They cannot be blank check companies, investment companies, or certain types of development stage companies. And additionally, issuers must be current in their reporting obligations if they are subject to filing reports under Reg A or the Exchange Act. So in circumstances, for example, where we see a development stage company whose plan is to acquire an unidentified company, we've raised questions about eligibility. We've also asked questions when we see an issuer who holds or intends to hold a substantial amount of investment securities. In that case, we may ask for an analysis of whether the issuer might be required to register as an investment company, which would disqualify the issuer from being able to use Reg A. Last, if an issuer has not filed its required reports, we will ask them to file the missing reports in order to regain eligibility here. And then the third area where we've issued comments is generally the disclosure requirements. So of course, we also review disclosure for compliance with the rules, and we will issue comments here. This includes a review of both the narrative disclosure about the company and its business, as well as the financial statement disclosure. So we've talked about the differences now between Reg A offerings and traditional IPOs. We've talked about the review process. And last, I'll just briefly talk about the routine comments that we hear from the public. And that includes—
Sorry, Brian, do you mind if I just interrupt with a quick question?
Yeah, sure.
On this, so you said Reg A is not subject to Section 11 liability. Can we just sort of understand why that's the case?
Yeah, and that's just a result of the statute. So Section 11 only attaches to registration statements at the time of effectiveness. So if you're doing an offering that's exempt from registration, Section 11 liability just does not apply as a matter of law. Does that help?
Okay, thank you.
Yeah.
But actually, now that Erica's asked a question, I'm going to
Mhm.
jump into
Sure.
because I can't help myself. So, understanding the lack of civil liability here, but it sounds to me, if I heard you correctly, that Reg A issuers effectively must remain in compliance with Section 5, even though that's not explicitly authorized or recognized by the SEC. So it sounds like they're protected from civil litigation, but a lot of the other compliance that goes into an IPO, they effectively must also maintain. Is that correct?
So they still need to comply with all the requirements of Reg A. So if they don't on the compliance point, if they aren't complying, they'd lose the exemption. And then it could be a Section 5 violation, which hopefully helps. And then I'll just note also, without getting too in the weeds, that they are still, even if Section 11 liability doesn't apply, I think as Stacy mentioned, the anti-fraud provisions still do. Is that helpful?
Sort of. Keep going.
All right. So we'll wrap up here by talking about the routine comments that we hear from the public. So from time to time, the commission receives comments regarding Reg A, and those commenters include issuers themselves, practitioners, and also academics. I'm just going to talk briefly about the few of the more routine comments that we've received over the years since adoption. So first, since Reg A Plus's adoption in 2015, some commenters have recommended preempting state securities law regulation of secondary sales of Reg A Tier 2 securities, which is already a common theme that we've heard today. At the time that we amended Reg A in 2020, the Commission noted that this recommendation merited careful consideration and that they were not adopting such change at that time. The Commission has also received comments on whether to expand preemption to Tier 1 issuers, but in 2020, the Commission stated that they continued to believe it was appropriate for states to oversee Tier 1 offerings. And in addition, the Commission has generally received feedback on the differing requirements specific to Tier 1 and Tier 2 issuers. So, for example, various commenters have suggested raising the $75 million offering cap for Tier 2 offerings, eliminating or lessening Tier 2 ongoing reporting requirements, as well as eliminating the requirement to provide audited financials in Tier 2 offerings. So with that brief overview of the comments that we've received, I'll now turn it back to Stacy to discuss some of the data if there are no other questions.
Actually, Bart, can I ask one other question? Just in terms of the ongoing reporting requirements, you mentioned that it's on different forms and it's sort of, Form 1U, but like, how parallel is it to 8Ks and 10Qs and 10Ks? Is it the same level of requirement, or is it, a lesser standard, or how does the ongoing report requirements compare?
Yeah, that's a great question. I'll just kind of say that again, that the views I expressed today, are provided in my capacity as a member, but don't necessarily reflect the views of the commission, the commissioners, or other members of the staff here. So, but with respect to that, I'd say that you can think of them as analogous, but reduced to balance the differing parts of our mission. So if you take a look at a Form 1U, which is the analogous current report, similar to the 8K form in the registered world, you'll see similarities, but you'll also see differences, and mainly that as you move up in the registered context, the disclosure requirements, I'd say, are heightened. Is that helpful?
Yep, thank you.
Okay. And another note there, we have in Reg A Tier 2 offerings, they're subject to annual reports and semi-annual reports, right? But 34 Act companies, they also they file 10 Qs on a quarterly basis. So that's another example. All right,
Thanks, Brian.
Stacey, I'll turn it back to you. Yeah.
Yeah. Thank you so much. Stacy, there was a question I wanted to ask. We know your office does regular outreach and engagement. What is your office hearing from small business stakeholders or their advisors about Reg A?
Sure. I'm happy to address some of that. So some of the things that we're hearing is, so we've had a chance to talk to some stakeholders, attorneys, people who have done Reg A offerings. One of the things we hear, there are a lot of specific sort of business models that turn to Reg A, and things like, and this was something new to me, like funding independent film projects, or owning a partial interest in real estate, or owning a partial interest in a piece of art. And part of the rationale for that we heard is that sort of the economies of scale. So almost as as a company buys a piece of artwork and goes through the Reg A process multiple times, sort of that ability to scale the costs of the Reg A offering can start to be realized by the issuer. Something that doesn't necessarily happen with crowdfunding. So sort of as companies do multiple Reg A offerings with subsidiaries, they get the process down, they get through the qualification process, and so they start to reap some of the benefits of kind of the costs come down as they do more Reg A offerings. So that's one of the things that we've heard. Another thing we've heard too, sort of with that particular kind of unique deals, that sometimes those investors, it's almost a little bit more like crowdfunding. They're kind of loyal. They want to support that particular sort of offering, whether it's an independent film or it's, to be an owner in a piece of artwork. So they might be a little bit more patient investors. They're not necessarily looking for immediate liquidity when they go into some of those kind of particular deals. And so that can change the dynamic a little bit. But we do still, some of the things we hear from our stakeholders, and I think some of the commissioners said this as well, thinking about, are the offering limits the right offering limits? Should there be some scaling of the disclosure requirements to make Reg A a little bit easier? One of the things I apologize, Erica, if I'm answering more questions than you actually asked as I look at my notes. One of the things we heard in particular from the GC of a company that had done a Reg A offering was being surprised about sort of the marketing aspect of it. So having to secure that broker dealer, the amount of time it took to get a good broker dealer to help with the marketing, to be able to make the offering a success. So that was sort of one of the unanticipated aspects of the Reg A offering that particular general counsel highlighted for us. So I think hopefully I answered your question.
Yeah, absolutely. Definitely appreciate the marketing as kind of like an unexpected challenge, and that makes a lot of sense. Have you gotten any feedback on just sort of the economic viability? Whether as they say, the juice is worth the squeeze based on the cost of these offerings compared to other capital raising pathways?
I would say, I think we do hear from stakeholders, similar to crowdfunding, that the costs of a Reg A they're a balancing act. And whether it's a cost-effective method to raising capital, again, I think it circles back to what I started with, where sort of these more unique business opportunities where you've got a company and sort of their business plan is they buy particular pieces of artwork and then take investors, sort of drop a subsidiary and do a Reg A offering. So I think that's where they can sort of scale those costs and make Reg A a little bit more viable. I will say one of the things we heard from an attorney that we spoke with is keeping in mind that even with a tier 2, while it preempts state blue sky laws, they still have to file with the state and pay a fee to the state. So even though tier 2 doesn't have to go through that review process at the state level, there are still some costs associated with making the notice filing with the states. And then obviously with the tier 1, additional costs would be going through those blue sky laws. So I think that's something that we hear, that there are definitely some costs there. And I think also, the cost of hiring that broker dealer to help market the deal to make it successful as well.
Well, it sounds to me, overall, having never done a Reg A, but having done many non-registered offerings, or not many, but several non-registered offerings with accredited investors, and then having gone public, I can see how Reg A might be a useful vehicle for, I would say, sophisticated but more niche companies, such as crypto, such as, fractional ownership of art, where you're dealing with highly sophisticated and perhaps scalable, small business models. But having listened to the regulation burden and just the expertise required to comply and to avoid a footfall, when I think about another type of small business trying to raise $10 million, the hurdles, the compliance hurdles, but also the inability to, the difficulty of crossing state lines and the inability to sell shares. I can see how that would be enough of an impediment that many of those potential offers would just rather just work with accredited investors. Having listened to all of this.
Yeah, absolutely. That's a very, very good point, Laura. Um, One other quick question I just wanted to cover before we move on is just Stacy and Brian to get your perspective on the secondary market liquidity concerns and challenges. Like, do you think that might also be a deterrent from issuing Reg A? And what evidence or feedback have you heard from issuers or investors on that?
And I'll let Brian weigh in as well if he would like to. That is definitely something we hear from our stakeholders, that particularly, with the tier 2, that not having ready liquidity for resales is impacting the use of Reg A. And again, I think if we circle back, Dan Zinn, when he was at our last meeting, talking about OTC and what they've been trying to do to sort of create a little bit more liquidity. I can't remember exactly what Dan said, but I would say, yes, I think that's something that we're all hearing, that lack of preemption, particularly with tier 2 in the secondary sales, is impacting, I think, possibly the use of Reg A, or at least that's what our stakeholders are telling us.
Madam
Thanks, Stacey.
Chair, I've got a question, if that's okay. It's Herbert.
Yep, just jump in.
Hey, Brian and Stacy, if I heard you correctly, or did you say that, so if I did a Reg A offering, I could not invite a fund of funds firm to invest? And if that's true, is that any size fund of funds? They could not invest in a Reg A offering that I put on the street?
Brian, did you want to take that? Or
The question was whether you can solicit from a fund to invest?
Yeah, fund of funds, yeah.
I mean, as long as you're meeting the investor requirements there, if they're just investing, that sounds okay, but I'm happy to chat offline. If I'm missing something more nuanced in the question.
No, when you were talking, you said at a certain level, if that fund of funds came in and they had a majority position in the offering, I thought I heard you say that you would.
That's okay. Yeah. Okay. Thanks for clarifying. Yeah. So that was on the point of issuer eligibility, and that's if that's right, that if the issuer itself is holding investment securities that seem like it's a substantial amount, then it might raise questions about whether the issuer appears to be an investment company, and investment companies are not eligible to use Reg A.
And that's no matter the size of that investment company?
I'm not an investment company lawyer, so I don't want to pretend to be.
Okay.
Yeah,
Okay.
typically what we'll do is if it's kind of facts and circumstances analysis of, if the facts start to look like they raise questions about whether the issuer is an investment company, then that's where we might have comments.
Oh, and just one follow-up question. I know that there's the technical assistance site, FinHub. is there anything similar to that for folks who want to do Reg A? Because I can imagine trying to present an offering and not having clue, and my attorneys would love that because they'll take one question at a time without summarizing everything that they think I need to know at that point.
Yeah, that's a great question. Stacy, I'll let you jump in here also, but the small business resources page on the SEC's website is a really good resource, and there's lots of tools there, including some good guides and explanations about Reg A and how it works.
And I mean, correct me if I'm wrong, Brian, but if somebody had a very specific question, they could also reach out to OSBP.
Definitely, yeah. Yeah, we get questions all the time. So
Okay.
you can call into our phone line and someone will get back to you and we'll chat.
Great. Thanks a lot. Thank you, Madam Chair.
Yeah, thank you. And thank you, Brian and Stacy. Brian, we're all going to be giving you a call whenever we want someone to discuss securities regulation with. So you put it out there, expect to get lots of phone calls from us with follow-ups. But thank you so much for this overview. It was really, really helpful. All right. So as I mentioned at the outset, today, we plan to spend the meeting continuing the exploration of ways to expand access to early stage and growth capital raising by focusing on how companies have used Reg A for capital raising. We just had a fantastic Reg A primer, and we know this pathway is less frequently used than other capital raising pathways like Regulation D, and is also different in some significant ways from a traditional IPO. I'm hopeful that with the benefit of our invited speaker, we will have the opportunity to hear more about some of the advantages and limits of Regulation A offerings, along with practical market considerations that impact the desirability of Reg A. It's important to consider not just the issuer perspective, but the investor perspective as well, because savvy investors are hoping for a return on their investment. We need to understand how that will occur in Reg A offerings. To that end, we're going to consider exit opportunities for investors in Reg A deals and secondary market liquidity challenges. Ultimately, the committee will explore whether there are changes that could help facilitate capital formation pursuant to Regulation A and improve secondary liquidity for investors in Reg A offerings. It is our hope that we'll be in a position to culminate this discussion by proposing related recommendations. So, to facilitate the discussion and deepen the committee's understanding of certain capital raising frictions, we will be hearing from an attorney who is well versed in Reg A. I'd like to now introduce and welcome Daniel Foreman, partner at Lowenstein Sandler LLP. Daniel represents public and private companies, investment banks, private equity sponsors, and venture funds in a wide range of capital markets transactions. Daniel also has experience advising public companies, both large and small, on their SEC reporting obligations and corporate governance matters. He works with clients across numerous industries, including life sciences, technology, retail, and consumer brands, industrials, and financial institutions, among others. So welcome, Daniel, and thank you so much for being with us today.
Thank you very much, Erica. Let me see if I can share my screen, and that works. Okay, how is that? Good? Great. Good morning, and thank you for having me. It's an honor to speak with you today. The committee's work is incredibly important, and through your recommendations, you provide invaluable perspectives on the capital markets and how they're serving the needs of small businesses and their investors. The importance of regularly evaluating how the capital markets are functioning and ensuring they are providing small businesses with the opportunities to raise funds for growth and investment, and individual investors with the opportunities to participate in this growth is vital for the long-term success and the efficient allocation of resources in our national and local economies. So thank you again for inviting me to join your discussion in considering the current state of play as it pertains to the rules and regulations of capital raising for small companies. And I hope my experiences and perspectives can aid the committee in making recommendations that will facilitate capital formation for small businesses while still protecting investors. In particular, I look forward to focusing our discussion on Regulation A and its potential and limitations as a capital raising pathway. As Erica mentioned, I'm a partner in the capital markets and securities group at Lowenstein. Our practice focuses on advising private and public companies on securities offerings and capital raising activities. Most of my practice supports small and mid-cap companies, public companies with equity and debt offerings, and private companies pursuing public listings through IPOs, de-SPACs, reverse mergers, direct listings, and Regulation A. Our firm focuses on emerging growth in small cap public companies, as well as startups and venture capital. So over the years, I've had numerous conversations and worked on a number of Regulation A offerings for a variety of types and sizes of businesses, and have had many conversations about the potential of and use cases for Regulation A. We've worked with issuers on their Regulation A offerings and also investors participating in, considering, and sometimes investing alongside a Reg A capital raise. As the data from the Office of the Advocate for Small Business Capital Formation's annual report indicates, the number of Reg A offerings has declined over time, and so generally, anecdotally, has interest in the offering type. I note that usually, or what's happened over the past years, I guess since back to 2015, is we see excitement and interest and people asking about the offering when it was introduced and became effective in 2015, again when amendments were adopted and became effective in 2018, and then again when the maximum offering amount for limitation under Tier 2 was increased to 75 million from 50 million. So issuers in general and investors like what Regulation A offers in concept. However, as is also clear from the data in the annual report, there's far more activity and companies are raising far more in proceeds from Regulation D private placements and also from initial public offerings and other registered equity offerings. So I'm happy again to just feel free to interrupt if you have questions while I'm going and to aid in the conversation. I wanted to start with some points why companies are drawn to Reg A. And when companies sort of read on the SEC's website or they see another company doing a Regulation A offering, there are some things that stick out for them. And they come and they're very excited about Regulation A, and there are a number of things that they like when they're thinking about either doing an IPO or a private placement. For one, the offering size limitations for both Tier 1 and Tier 2 are very attractive for small businesses and small companies. And for many of the companies we speak with about Regulation A, the ability to raise significant amounts of capital under a Tier 2 offering is very attractive. Many smaller companies that might otherwise be considering or aspiring to a smaller, let's say $30 to $50 million IPO, see Reg A as a really valuable potential alternative. Companies also like that Reg A is not an all or nothing raise like a traditional IPO. So when you're doing a traditional IPO, you basically set yourself up for a 2-week roadshow and you go on the road and the market window has to be just right and the securities are underwritten by an underwriter and placed, and it's very much a momentous event. But if the market window isn't there when you're going public, that could also take the 6 months, 1 year, 2 years of preparation and subject it to risk. So what companies often like about Reg A is they can qualify their registration statement and over time sort of build up and raise proceeds. That can, though, that all or nothing approach, though, can also work against the issuer. I think what we often see, and I know we're talking about the positives here, but we often see is that companies go and they look to raise $20 million, $50 million, and they get comfortable with what their outlay on expenses are going to be. But in the end, what they actually raise under the offering is a fraction of that. So that's something that when we're talking to issuers, we advise them on, and we say, well, what's the minimum that you're looking to raise here? and consider that in connection with what the outlay on expenses is going to be. What companies also like about Reg A as compared to other registered offerings is, they're considering an IPO, and what they hear is that this is a mini IPO or it's IPO light, and that there are lighter levels of disclosure that you get with a Reg A offering. And that's something very attractive to them. Most small companies do not have the resources to dedicate to the preparation of extensive securities disclosures. And probably more important, it's not just drafting the disclosures, it's the processes that go into building those disclosures. So it's creating the data room, it's working with your lawyers and investor relations team, making sure that the information that you're putting in that registration statement is accurate, that it's free of misstatements, and that there are no material omissions. So there's a significant process that goes on behind the scenes, as opposed to just kind of putting together, a document. And there's often the view that companies have, particularly smaller companies, that, hey, my business is smaller, it's relatively simple, it's straightforward. Investors wouldn't necessarily get anything more value if I had another 50 pages of disclosure or 20 pages of risk factors. Why do I need that? So while it's true that the offering circular requirements for a Reg A offering may be seen as a lighter touch, when we actually kind of get into the details of it, I'd say that many issuers are surprised that they're closer to the requirements for a registered offering like an IPO, rather than something that you would find for a Reg D private placement or something for under the crowdfunding regulations. Separately, the ongoing reporting requirements for Tier 2 issuers are generally more limited than they are for regular SEC Exchange Act reporting companies. So as mentioned before, you have annual, semi-annual reporting and current reports with that Form 1U resembling a Form 8K, but I'd go and say that this is a lighter touch. Certainly, you don't have the quarterly reports that an Exchange Act filer is required to file, and they are less demanding in terms of putting them together. So it actually is something that's very attractive to Tier 2 issuers. And as also mentioned before, Tier 1 issuers don't have these ongoing reports apart from that 1Z exit form, which they're required to do, which is not altogether that demanding. Something extremely important when we're talking to companies about whether to go public are financial statements. And financial statement requirements for Reg A issuers can also be much more flexible and accommodating. And I think it definitely draws the interest of smaller companies. So for an offering under Tier 1, issuers are not required to provide audited financials unless, as mentioned before, they've already prepared them for other purposes. And issuers in Tier 2 offerings are required to include financial statements in their offering circulars that are audited, but they can either be audited based on AICPA standards or public company accounting oversight standards. So being able to elect to provide AICPA audits in lieu of the PCAOB audits can save companies thousands upon thousands of dollars in offering costs. So to the extent that you are not considering a listing or otherwise going to require a PCAOB audit, this can save companies thousands upon thousands of dollars in offering costs, and is actually something very helpful in the framework. And in addition, just as for regular way IPOs, that transition from private company accounting to public company accounting takes a good deal of work and internal effort by the management team. Usually, companies need to bring on additional resources, either by hiring third parties or bringing in consultants, or actually hiring additional personnel who have experience in public company accounting. So the ability to have scaled financial statement disclosures and requirements is something that very much attracts issuers to Regulation A. Another feature of Regulation A that is you can find in an IPO, but you can't find in other private placements, except regular crowdfunding, is that you can get access to a broad investor base and there's marketing flexibility. So under IPOs, with a regular way traditional IPO, one of the first things we focus on with issuers is talking about how strict the communication rules around IPOs, how gun jumping works, how communications as you approach that IPO period really have to be limited. And for smaller companies, not only can that be difficult to understand and implement, but for many issuers that find Reg A attractive, it actually goes against what they're trying to do in their business, which is to do more outreach, to get people to know them, to increase brand exposure. So something attractive about Regulation A is the allowance for general solicitation, the ability for issuers to broadly market their offerings to the public. Is often a compelling reason to pursue a Reg A offering. And sometimes, we've had discussions with issuers and small companies where the ability to market the offering directly to their customers or their users of services was extremely valuable, not only as a means to raise capital, but also as a way to connect with customers and users and deepen those relationships. So I think that's something very unique with Reg A. And actually, if you look at IPOs, traditional IPOs, there is a lot of effort on consumer-facing companies and brands to find ways to get their shares, or at least to have their customers become investors as well. So through directed share programs and other types of outreach to retail investors, there really is this sort of connection that companies want to build with customers who also become investors and believe in the product. As has been mentioned a few times before, and I know as this committee has considered, unrestricted securities and some help with preemption of state securities laws in Tier 2 does make Reg A offerings sometimes more attractive than private placements. So securities sold in Regulation A are not restricted securities. They generally can be freely resold by non-affiliates under the federal securities laws. However, that's all subject to applicable state securities laws. This is definitely a significant potential benefit of Reg A over other exempt offerings, including Reg D, since many investors want the ability to have freely tradable stock, and certain investors cannot hold restricted securities. However, that's where things get a bit sticky because, as we've been talking about, Tier 2 offerings provide for preemption of state registration and qualification provisions only for primary offerings of securities by the issuer or secondary offerings that are qualified under Reg A. So as we were talking before, if the issuer is doing a Reg A offering and is issuing up to $30 million of shares, insiders, directors, officers, affiliates, sort of meaning 10% holders generally, they can also sell at that same time. And that would get preemptive treatment to get through state securities laws and not have to be separately registered or qualified. However, once you get into the secondary trading, the purchasers of those shares need to, if they're looking to sell those shares in the future, need to consider how they're going to sell them and whether and how they're going to comply with state securities laws. So many sort of Main Street investors, like when they think about this issue, that's something that's very complicated. And not only does it prevent liquidity on the back end, but for investors who are making an initial purchase decision, that will also prevent them from making that initial purchase. So it's not just, I'm going to buy the securities, and then 6 months later, or a year later, or 5 years later, what am I going to do? It's, do I really want to purchase this security that if I need to sell, I'm going to have to figure out like who I'm selling it to, where they live, where I live, what the laws are. That's a very complicated process, particularly for a retail investor who I think, the committee and the SEC and everyone would like to see have the opportunity to participate in these types of offerings. And you add on top of that there are not many secondary trading facilities for these shares, and that can prevent an issue. That can prevent an opportunity as well. However, we're sort of close there, right? Because there are unrestricted securities, and there is preemption on that first piece. Just a few other reasons why companies may be drawn to Regulation A. Generally, Regulation A offerings are typically less expensive, much less expensive than a traditional IPO or other registered offering. Companies don't have, for a traditional IPO, you're looking at costs starting, around $1 million up to $2 million at the low end. That's accounting, that's legal, that's, that doesn't even take into consideration the underwriting discount that investment banks will charge on a traditional IPO, which is, 7% in fees, 7% of the proceeds raised generally. And so, a Regulation A offering is much less expensive than that. And so, being able to sort of think about doing a mini IPO for a lower cost, and you're raising sort of the proceeds you need to advance your business, that's very attractive. And
Sorry, when you say, lower, can you give us some specifics on that? So, minimum $1 million for an IPO, like what would the cost structure be here?
So for a Reg A offering, again, it's probably very different for a tier 1 and a tier 2, depending upon the capital raised and whether or not companies are going to use a broker dealer for a Reg A. But if we're talking, you're starting at $1 million for an IPO and $1 to $2 million for a traditional registered IPO plus the underwriting discounts, you're talking $100,000, $200,000 more in that range for a Reg A offering. So there is a significant difference of scale. I mean, it can go up, if you're doing a more significant Reg A offering at tier 2, I think you're looking at probably closer to, in that between that 250, 500 range. But I think that varies pretty widely based on, which services you're looking to build in, who you're hiring for these various services, and how you're looking to build those costs, and whether you're a repeat issuer, I think as well. And the other.
Okay, so just a quick question on the structure there. So let's say, you're looking at 100 to 500 in kind of like the fixed costs, and then no sort of transaction fee, maybe for your own investors that you brought in through customers, et cetera. But then, you probably still would have like that 7% if you're using a broker dealer to find additional investors.
Yeah, so the fees for broker dealers differ, and you could sort of go to a broker dealer. You could use often in Reg A offerings, firms are hired to help market the offering. Like a lot of the times, because of the general solicitation, the availability to go out and solicit widely, you sort of bring in a marketing firm and they help you and they help get the word out, and that also can be a cost, and a number of broker dealer investment financial advisors can help with that as well.
Thanks.
And then just a couple of other two other items that Stacy had mentioned that issuers really like, and both with registered initial public offerings as well as Reg A, the confidential review of the registration statements that the SEC permits, that confidential process where you can work on your disclosure and receive comments from the SEC and get feedback. Doing that in a confidential way is very helpful and very attractive to issuers. If at some point they decide not to do the offering, they can simply withdraw that confidential registration statement and don't sort of have the reputational risk of having gone out there and tried to do this and it not working. So they can, explore this, move this down the pathway, and if a more efficient way of raising capital appears, so if you're working on like a Reg D private placement, you can sort of pivot to that quickly without putting all this disclosure about your business out into the public market. So that's helpful. And just as in IPOs, the testing the waters innovation that was mentioned before, where issuers can go and speak to institutional investors about their story and see how that resonates. Testing the waters is extremely important, not only for getting indications of interest or just getting feedback from these investors, but sort of having a chance to tell the story and refine it over time. So we talked a little bit about earlier the types of companies that use Regulation A or who it makes the most sense for. And so, when we speak with companies about it, a lot of the time, there are some companies that a Reg A offering doesn't make sense for, and we say, well, you should consider these other things. But there are a number of companies where a Reg A offering does make sense, and they can take good advantage of the framework. So companies that have strong brand recognition and or a loyal customer or user base can leverage general solicitation and the marketing flexibility to generate investor interest. You've seen this, given the growth and prominence of direct consumer brands and increased interaction generally by companies and their users and users of their products on social media over the years. Customers and users can be a great source for capital and interested investors who support the company's mission. Many traditional consumer and tech IPOs, mentioned this before, utilize programs that work within the IPO and the securities framework to reach these consumers. But the ability to reach out to retail investors directly is certainly an advantage that Reg A has over other exempt offerings. Companies that excel in self-marketing, that really can put out a press release or an email to their customers and really have a great identity and can sell themselves, often find success because not only can they sell their products, they can also sell the story of the company and why investing in the company helps the mission, and investors and customers really want to be a part of that, and often those two aspects join together. We talk about sometimes that every company, their dream is to IPO, but for a lot of companies, they're not ready to IPO. They're not ready for the burdens of complying with the public markets or answering analyst questions every quarter. So some companies just aren't ready to IPO, and some don't want to IPO. They want to find a way to access capital, maybe it's that $20-30 million of capital, but they don't, want to go to the next level. They don't want to deal with the reporting obligations and costs of compliance because that doesn't make sense for their business. And there are a lot of companies out there that are deterred from going public that have great prospects because it's just too much for them and will distract them from running their everyday business. So for those companies that want to be able to raise, let's say, $25 million up to the $75 million limit that Reg A allows, and they want to stay private, they don't want to be public companies, Reg A is potentially a really good choice. Real estate platforms have used Regulation A with a lot of success. I think that's also in the annual report where you see where the offerings are coming out of in terms of industries. I think real estate platforms usually are administered by folks who are very familiar with financial statements and financial structuring and disclosures, and they also benefit from, I think as Stacy was mentioning, so as you do more of these offerings and you accumulate capital, Reg A is sort of great for that because you can fundraise, invest the proceeds, and continue to fundraise and sort of build up over time. And so platforms that invest in real estate have found, I think, a good deal of success and interest in Reg A. And these offerings also, or these platforms also, I note, sometimes aren't, or they usually aren't as dependent upon that secondary trading. Like they could offer yield to investors through their securities, and so sometimes the real interest in the securities is holding them and getting dividends off of them, which you would get from the real estate income, as opposed to sort of secondary trading and having those secondary markets. So it's something where an issue where the secondary aspects of secondary trading for Reg A aren't as relevant. Commissioner Person mentioned sort of the digital asset space, and I think years ago, or a few years ago, there was sort of like, are Reg A offerings perfect for like initial coin offerings in the digital asset space? I think not considering sort of whether crypto offerings should be done on Reg A, I think there's also a lot of reason why digital asset companies who are tangential to the crypto space may find Regulation A attractive for capital raising. Typically, they do have consumers or users of their platforms that are very invested in the platforms and have that same brand alignment and platform alignment that you would see in direct to consumer brands that are mission driven. So I could also see those issuers succeeding using the Reg A offering framework.
Sorry, could you just be a little bit more specific there around like an example? I'm not sure I quite follow how the crypto company versus the D2C company would have the same benefits.
Yeah, sure. So for a crypto related company, so if a company is operating a platform for trading various crypto assets or tokens or coins, and they're looking to capital raise to build out the platform, but not necessarily sell crypto assets, they would have probably a strong social media presence. They'd have a lot of users of their platform that would be invested in the success of their platform, and in that way, both users of the platform would seek to be investors of the platform. So they could do similar outreach to a company where maybe you're selling clothing products, and you have this direct connection with those who are buying your products who would also want to invest in you. Lastly, though, most of my commentary is focused on tier 2 companies. For companies companies raising capital in tier 2, for companies looking to raise more capital than the crowdfunding limits, but up to that $20 million, and for some reason they can't do it through a Reg D private placement, tier 1 of Regulation A would allow them to go and try and raise those funds from the general investing public. And I think what you'll see is sometimes founders who have built up their business, maybe they've used some family money, but they don't have an institutional lead investor like a venture capital firm in their equity capital stack. They may not be able to sort of get that traction or know how to access the networks necessary to get an institutional investor into a to a Reg D. And so if they're looking to raise $10 million, maybe Reg A is a better way to do that, by gaining access to retail and general investors. So next, I want to talk a little bit about the difficulties and the limitations of offerings under Reg A. So some of it, I think, is competition with, if we can call it that, with sort of the other offering types. And I think this goes to Commissioner Peirce's sort of which supermarket should I go to and what are the frictions there. But so when given a choice between raising capital via private placement, such as through Reg D from, let's say, a venture capital fund, a family office, private equity firm, or even looking at bank financing or private credit, versus a Regulation A offering where you're preparing for and taking a risk on doing basically a quasi-public offering, the answer when we're talking with issuers is often that the private capital is less costly, it's quicker to close, there's less, if any, ongoing reporting obligations with which to comply. It's happening out of the public space, right? So you can disclose what you'd like about it. You don't have mandatory disclosures. And also, to the extent you can have an anchor venture capital fund on your cap table, there are also benefits that provides beyond just capital raising, right? There's guidance, there's connections to help the company grow. And in the current environment, or how the environment has been over the last 10 years, the availability and success of private capital has been so strong that it's not only taken sort of probably capital out of Reg A or diverted capital that otherwise have gone to Reg A, but it also, as we know, has taken a bite out of the traditional IPO market. And I'd say that notwithstanding that I'm a public securities lawyer, right, and part of my focus is taking companies public, when we talk with companies like, should you take private capital or should you go public? The advice is often you should stay as private for as long as you can, provided you can get the capital you need to raise to run your business, unless there's another compelling reason why you would want to go public and a public listing makes sense. That could be, my employees need to get liquidity for their stock. It's really important that I'm a public company because it adds credibility and reputation, and it'll mean a different thing for raising the profile of my business and getting customers or securing suppliers. So, but private capital has a number of advantages that I think we all need to think about as we kind of think about where Reg A fits within the framework of capital raising. And so, assuming that a capital decides it needs to go and access capital from the public markets, there are some advantages to a Reg A offerings. But when you look at the process and potential outcomes side by side with an IPO or other registered offering, many companies come to the conclusion that a Reg A offering is not the best capital pathway, and it actually could be damaging to prospects of the company down the road. There are a number of clients who have considered a Reg A and honestly have ended up taking more expensive capital from private sources to bridge them to a traditional IPO or a reverse merger because they didn't want to put efforts into a Reg A offering that they ultimately would not be able to sell. So there are also complications for pursuing, let's say, an IPO after you've completed a successful Reg A offering. For example, when you're doing an IPO, it's usually very closely orchestrated, again, with communications, but also with expectations around valuation. And you've already put a lot of public disclosure out in the market if you've done a Reg A offering. And sort of if the story changes for the company since that time, it sometimes becomes difficult to adjust the market to those new expectations. And if you do have a very successful Reg A offering, for example, you end up with a large shareholder base that could consist of thousands upon thousands of retail holders, and then trying to manage a tightly controlled IPO after that can be very difficult for issuers. So there are lots of logistical considerations for the company to consider with such a large shareholder base. Some of the other drawbacks of Reg A offerings as compared to a private placement include high upfront costs for the offering as compared to the amount of capital being sought. So I know it's much lower than an IPO, but it is higher than for a private placement or a VC round. And there is, though it is more streamlined than doing an IPO, there is still, for a small business, a rather complex and lengthy regulatory process and ongoing reporting burdens that you need external advisors to help with, and that you do have to pay when you call them, or when you engage them to help you through that process. And I'll say that while there has been much said about IPO underwriting fees, 7% is very high when issuers hear that number, right? It is very difficult to successfully market and sell securities of small companies to retail investors. In many Reg A offerings, issuers do try and do this themselves. And many other offerings, more so in tier 2 offerings, you have underwriters or placement agents, financial advisors, they're involved. And there are some Reg A market specialists, but generally the markets around Reg A have not developed in a way where there's been as much interest or participation from investment banks as I think would have been hoped when it was first introduced. Or might have been, expected when the offering size limitations increase. I think some of that is likely.
And I apologize, Dan. I think we're bumping up against time. So, thank you so much for this. This is great.
Yep.
Hopefully we can wrap it up in the next couple of minutes so that everyone can get in a quick break before our discussions. But thank you. This has been wonderful.
Okay, yeah, no problem.
Great. Is this the last slide, or do you have any?
Oh, yeah. So I
wrap-up
can.
you would like
Yeah,
to?
I can just do a last slide for a quick wrap up.
Okay.
So
Great.
just some thoughts quickly on where to next for Reg A, and certainly for the committee to think about. So I think as has been mentioned, I think preemption of state securities laws is a significant topic worthy of consideration, and I think is something for the committee to consider. ways to improve the Reg A ecosystem and involving market participants and educating them on how maybe this can be improved. I think reconsidering the tiers more so than even thinking about the offering limitations is something that is worth consideration. I think, you have a set of companies where, maybe they're looking to gain access to a broader universe of investors, more than crowdfunding. That's probably one group. You probably have another group of companies that have greater capital needs than 20 million, but are not ready to IPO. And consideration should be, given to them that they should have scaled disclosure requirements. And then, additional consideration should be given to companies with greater capital needs, but that want to use Reg A potentially as a jump off to a traditional IPO, or have an alternative to an IPO. I think has been discussed before. In order to go public, you're looking at companies with market valuations of $1.5 or $2 billion. There really has been there is a lot of white space that's been left where companies that are smaller, that are looking to do capital raises of $100 to $150 million, just don't have the opportunity to go public. And I think expanding opportunity under Regulation A could give them a lot of opportunity to do so. So I'll stop there. Thank you again to the committee for the opportunity to speak. And I look forward to hearing the recommendations that you put forward on this important area.
Thank you so much, Dan. That was really, really informative. And hopefully we can get those slides from you after to continue to inform our discussion. I appreciate it. And I want to thank you, everyone who's shared their perspectives this morning, for helping to bring these conversations to the Commission. For those watching on sec.gov, the committee will take a short break and return at 12 p.m. Eastern Time. We look forward to having you all back at the top of the hour.